Investors looking ahead to this week's key economic data that could influence, whether the Fed will begin cutting interest rates anytime soon. My next guest says now's the time to position for fewer cuts ahead. Joining me now at Post 9, Elizabeth Burton of Goldman Sachs. Good to see you. Welcome.
Good to see you, too.
I mean, I think that's partly what this market's been figuring out, how to best position for fewer cuts and higher for longer. What's the best strategy right now? What are you telling your clients?
Well, I do think that folks should be thinking that we may have fewer cuts. I actually think if I was still in the CIO role that I would be thinking about protecting my portfolio for an even longer extension, because I think there's always risk that those cuts could be pushed further out, even if it's not our baseline. It's a bigger risk to portfolios for, a quarter-point hike than a quarter-point decrease. And if you're a CIO managing a large pool of assets, that's your concern, not, what's the Fed going to do and how many times this year.
You think the market needs cuts? I mean, how would you assess that question? You hear, the economy's awesome, it's incredible, we don't need rate cuts, but the other school of thought is like, well, at some point we do, and we may get them this year, just so what if we don't get as many as we once thought? How would you answer that?
The market needs certainty. I don't know if it needs cuts, or it wants certainty, I should say. So no matter what's happening, I think that's the more important issue. So I won't say whether or not I think it needs it at this point. We still got time, too. Who knows what's going to happen between now and June? I think the harder challenge is deciding what to do when you don't know what's coming. Actually, I have a paper coming out in a little bit that talks about if you had perfect foresight into certain economic data, which things would you want to know? And none of the things I list are a quarter point here or there. Mm-hmm. It's more like, where do you think we are a year from now?
Okay, so then tell me how you would recommend investing with a year from now time horizon? Well,
for one, part of the reason I said that is I think investors are already on one side of the fence with respect to that, and I think they're looking for a little bit of confirmation bias either way. Mm-hmm. So thinking a year from now, if you think that rates are potentially higher, do you want to be locking in short-term rates? Do you want to be locking in fixed rate at this point, or do you think you have more bandwidth? I mean, short-term rates are attractive here, right? But that would change your opinion on whether it's important to do it right now or whether you have some leeway to think about some other sorts of things.
Do you actually think that rates could be higher a year from now than they are today?
I'm not saying that rates will be higher a week from now, but when you're managing assets, you want to think about the risks, right, to the upside. They could be the same level they are now, but I think what you're asking in the rate cut question is, are rates going to be lower a year from now? But
I think most people would think that they would be, because we're eventually going to get cuts, plural.
We are eventually getting cuts, right? And Goldman Sachs would agree with that message 100%.
Sure.
But is it now? Is it a year from now? Like that's what I'm saying. Like, what really matters is where do you think we are a year from now, not necessarily where do you think we are, at the end of July.
No, but I mean, between now, let's say, and the end of the year, do I want to be in small cap stocks? I want to be in cyclical stocks. Do I not, relative to where rates are today? Not so much where they're going to be a year from now. I've got to make some investment decisions that are going to carry me over the next few months, and maybe the landscape's a little bit different than I thought it was going to be, both from an economic standpoint and a rate cut standpoint.
Right. Well, on the small caps, which everyone's sort of talking about these days, and we're super constructive on them, we think that if there are rates cuts coming, that'll be a tailwind for small caps. In general, we think there's a lot of tailwinds for small caps, though. So do you have to wait on whether or not there's a rate cut in July? Probably not. There's other reasons why you should be looking at small caps right now. I think a big concern for investors continues to be, actually this is interesting, on our internal website, concentration was actually not in the top keyword search until this quarter. It wasn't last quarter, and now folks are worried about it, which I would have thought maybe they would have been worried about it in the last 2 quarters. So they're looking for diversification everywhere they can sort of get.
It's so interesting that you say you want to be overweight small caps. I mean, it is a good debate right now. The market action, I mean, the price action of the Russell would suggest that you don't, because anytime rates go up, the Russell's going down, and vice versa, obviously. So how would you contend with that?
Right. Well, in some parts, the Russell suffers from somewhat of a benchmark issue. Not everything in the Russell is maybe something that you want to buy. There are certainly, you want to pick your spots, and I believe that Goldman's been clear on that we think that this is a market you want to be active in. And by the way, not just in the U.S. We think like ex-U.S. it's an opportunity as well. But there's a lot of tailwinds behind that. And, we're all exposed. Most institutional investors have to be exposed to the U.S. equity markets. So they're just looking for other ways they can gain that exposure when they've already experienced so much frustration this year. Like, think about if you were in active management this year. How frustrated would you be with large cap active management, right? It's been tough. So I think they're looking for what else is there? Is there an alternative to this? Is there an alternative to what we're in now?
So let's take the large cap thing for a moment, and we got Meta obviously reporting tonight, and in the subsequent days we're going to have other big ones too. How do you feel about mega cap tech right now?
I think there's been a good story behind it. I think the bigger issue for me this week is I think I've said every time I've been on here that investors don't care about these short-term things. I actually think this time, like it or not, there's probably some caring. It's been such a big story. But again, I go back to the confirmation bias. People already know how they feel about what they think is going to happen for the growth outlook. And this week, these earnings are either going to confirm that or they're going to keep looking for other data points. We've already seen strength in the economic data that the U.S. is on a good path. Now we're looking for it in confirmation from corporate.